Hello, my name is Rachel and these are my colleagues, Patricia and Vivian. We are the three financial analysts of the RFM company, and today we've been asked by our CEO to give a presentation on our forecast analysis based on two pairs of currency. They are Euro over USD and USD over Japanese yen. In this presentation, we are going to present to you our view of currency market. And to do that, we have analyzed different economic indicators and other factors that of the respective countries that will affect the exchange rate. I'll now pass to my colleague that will continue.
Thank you very much, Rachel. So I will continue with our forecast of the euro over the US dollar. Our forecast is that the euro will appreciate in the short run, which is over the next 3 to 6 months against the US dollar. And I will explain you now why we think this is the case. First of all, we had a look at the inflation rates of both of the economies. The inflation rate in the United States as per July 2016 on a year-over-year basis was 0.8%. And this is according to the United States Department of Labor, more precisely the Bureau of Labor Statistics. However, the inflation rate was only 0.2%, also as per July 2016 on a year-over-year basis for the Eurozone. And this is according to Eurostat and the European Central Bank, which means that the inflation rate in the Eurozone is lower than in the United States. In our supply and demand diagram, we will show you now the effect of that. So a lower inflation rate in the Eurozone means that there will be less import from the United States because it's cheaper to buy domestically, and therefore there will be less supply of the euro. On the other hand, it also means that there will be more demand for exports and therefore more demand of the euro because it's cheaper to buy from the Eurozone than in the United States. Which means that our exchange rate moves from ER1 to ER2, which is an appreciation of the euro. Moreover, we had a look at the interest rate. The federal funds rate is currently 0.25% to 0.5% in the United States. This is according to the Federal Reserve System. However, the key interest rate in the Eurozone is 0%, which is according to the European Central Bank, and this has been the case since March 2016, which means that the nominal interest rate is lower in the Eurozone than in the United States. However, taking into consideration the inflation rate of both economies, we can see that the real interest rate is higher in the Eurozone than in the United States. And we will show you now in the diagram how this affects the exchange rate. A higher real interest rate in the Eurozone means that it discourages capital outflow from the Eurozone and therefore decreasing the supply of the euro because they can get a higher return in Europe than they could get in the United States. It also means that it encourages capital inflow from the US and therefore increasing demand for the euro. So this means that the exchange rate moves from ER1 to ER2, which is also an appreciation of the euro. We also had a look at the GDP growth rates. Real GDP growth rate is expected to be 2.2% in 2016 for the United States. This is according to the International Monetary Fund. However, it's only expected to be 1.5% in 2016 for the Eurozone, and this is according for the European Central Bank. However, it's hard to tell where this economic growth is coming from. When it comes from export and import, it would affect our exchange rate. But if it comes from consumer spending and government spending, it would affect the exchange rate less. Another factor is that the Fed hasn't intervened into the currency market since May 2011, which makes us assuming that they won't intervene into the currency market in the next 3 to 6 months. Moreover, the elections are upcoming in the United States, and this should be beared in mind. We don't know now how the election's going to be and who's going to win, so we can't say how this is going to affect the exchange rate, but it's definitely a factor that should be beared in mind. I would like to pass the word now to Vivian, who is going to continue.
Thank you, Patricia. I would like to make the forecast for 3 to 6 months for US dollar to over Japanese yen. It is predicted that US dollar will depreciate against Japanese yen. One of the factors that I would like to discuss about is the inflation rate. As you already know from the previous observation by Patricia, the inflation rate of United States is 0.8%, while according to Bank of Japan, the average inflation rate is negative 0.2%. From this observation, it shows that US has a higher inflation rate than Japan. Now let's take a look at the diagram. It shows that there will be more import into US and therefore increase the supply of US dollar. Although there will be a decrease of the demand as well for the export due to the high inflation rate, and therefore that will reduce the demand for US dollar. Based on the diagram, the high inflation rate will decrease the exchange rate for US dollar. Another economic factors that I would like to talk about that would affect the exchange rate of both countries is the interest rate. The interest rate for United States is 0.25 to 0.5%, while according to the data from Bank of Japan, the interest rate for Japan is negative 0.1%. This information shows that the nominal interest rate for US is higher than the rate in Japan, so US have a lower real interest rate. Now let's have a look at the diagram. Lower real interest rate in the US will encourage capital outflow for them and therefore will increase the supply for US dollar. Although this might discourage the capital inflow and hence decrease the demand for US dollar. As you can see from the diagram, the shift of the supply and demand curve due to the low interest rate will decrease the exchange rate for the US currency. Other factors, economic factors that might affect the exchange rate is the GDP growth rate. Based on the data from the World Bank, the GDP growth rate for US is 2.43% in 2015, while the growth rate for Japan is 0.2%. This shows that United States will have a higher economic growth rate than Japan, and it probably will affect the exchange rate as well. Other factors that might affect the exchange rate, as mentioned before by Patricia, the Fed has not been intervened into the market since May 2011, and also the upcoming elections in the United States might affect the exchange rate of the currency, but this is still quite unknown. I would like to now pass it back to Rachel.
Thank you to both my colleagues. Now, just to quickly sum up our presentation, we have concluded that Euro will appreciate against US and the USD will depreciate against the Japanese yen. Thank you very much for your attention, and now we shall start our discussion with our CEO based on these issues. Thank you very much.